talk a little bit about your gold holdings then. How much of what we've seen over the last week or so has to do with fundamentals, inflation expectations, and how much has to do with other things, do you think?
Good morning, Anna. Thank you for having me to speak to you this morning. We don't see that there's a big change in the fundamentals in gold. We know that there's a lot of talk about risk being very subdued compared to last year. It is true that we have less risk since September when Mr. Draghi declared his support for the euro and the eurozone. So we do have less risk from there, but I don't think risk has disappeared completely. That's just one aspect. The second is the concerns that inflation is not around. We don't see any inflation today, and so gold as an inflation hedge is really not relevant. What we've seen in the past and historically is that when money supply increases for extended periods of time, to a larger extent than real GDP, there is eventually inflation in the pipeline. Now, we've seen this happen for a couple of years already, and we're seeing even more money supply coming in from other central banks all over the world. So this trend hasn't changed. The reason I believe that we do not see inflation today is because obviously we have overcapacity built up over the world, and we have high levels of unemployment. And while this is ongoing, inflation will show up only very gradually. The real danger comes when we do have a turn and things look better. We see inflation already in emerging markets because they have a different composition in their CPI. But due to the way our CPI is composed, we will only see it when overcapacity and unemployment reaches different levels than they are today. But then the change can be quite dramatic and quite sudden. The third aspect is people are worried that quantitative easing is reducing. I don't see the connection, because the only reason that quantitative easing would reduce, considering we're so far away from unemployment targets, is if inflation were a threat. But now they're not worried about inflation. So I see a disconnect in the arguments, and I don't see a big change in fundamentals for gold.
Okay. Well, let's talk about other elements of your investment portfolio, Gillian. You're fairly neutral on equities right now. Explain to us the rationale for that.
Right, we have seen a very strong run-up since Mr. Draghi's announcement last September, a very strong run-up in Europe. The US has had a very strong start to the year. The only laggard is the emerging markets. Emerging markets did very well in the latter part of last year and have had a setback recently. When we see what happened in the US with a strong run-up, we have booked some profits, especially in consumer staples and healthcare. We believe that these two sectors are a bit overstretched at current valuations, and there are better opportunities elsewhere, but we would prefer to see a slight setback before increasing equity exposure in general. In Europe, we have seen the worries about growth, etc. There we have also had a very strong run-up in consumer staples and healthcare. Sure. And we've held these stocks for more than 12 months, done very well, and I think it's time to book profits there. So we're just scaling back. We are not very negative, we're just scaling back.
Let's talk about technology. We had a number of big US technology names reporting overnight. I know that you don't hold all of those, but you do quite like Intel. Why do you like that stock over others in the technology space, and are you not worried about its exposure from a move from PCs into mobile computing and tablets?
We do hold several other technology stocks. I used Intel as an example to show the kind of alternatives that we have for large multinational companies with stable cash flows, very strong balance sheets, and very high dividend yields. Because, for the last 12 months, as mentioned, there has been this gravitation to consumer staples and healthcare for those very reasons, and those stocks have done very well. When we compare valuations and we look at something like Intel with a profile that is more cyclical, but otherwise offering all the characteristics, other characteristics that investors are looking for, plus with low expectations built into the price, we were quite positive on the stock at around $20 just recently. Now after the results, we've seen a nice run up. The dividend is well in place, and there might be a possibility of buybacks. We've seen the announcement of results, which was better than the whisper number in consensus, and an upgrade of the forecast by the company, plus a possibility of increasing margins, or they expect to increase margins by the end of the year and launch some new products. So I think what we've been looking for is companies where the expectations are low, the chance to beat those expectations are high. And in an environment such as this, where a yield is sought after, good dividend yield, which is highly likely to be covered or even increased.